to Euros Box. In this video, I'm going to give a deeper analysis to TLT, the long bond ETF. If you like this kind of content, consider leaving a like. And as usual, nothing is in this video is financial advice. So if you follow my previous videos, what you'll know is that what has really been bugging me a lot is not so much that we weren't going to plow through this downward trend line, rather that as you break through trend lines, you usually see a retest of the trend line you just broke out of. And you can see that we had a very similar thing occur last year, right here. We broke through and then we back tested it. Now, this doesn't have to happen, but again, it's kind of been bugging me quite a bit. And the only thing I can do really is try to come up with a reason why we would see a backtest. And really, I maintain the view that right now, you really have to defer any judgment to data. And what could make TLT backtest this trend line is maybe inflation. The CPI data coming out this week, if I'm not mistaken. Right here. I think we have it on Wednesday. Yeah. That could, in the very short term, push the price down, TLT. And so you could actually see yields rising just a bit as the CPI number comes out. And perhaps it's a little bit hotter. Why would it be hotter? Well, perhaps you still have companies really front running tariffs, and that is just in and of itself rising prices as people continue to bid goods to try and anticipate the and front run the tariffs. But then again, that is a very very short term worry. Overall, I think that 2025 will be a positive year for TLT and bonds in general. And my expectation is that throughout 2025 and possibly 2026, depending on how things play out, the next time we revisit the upper level of this parallel channel will be the time we break out of it and we go towards the 110 level, which would be, if I'm not mistaken, around 380 on the 30 year. And why would we have that kind of a rally? What would be the cause of it? Well, just by looking at recent history, initial jobless claims have the tendency to bottom around the January time period and slowly move higher into the summer. Okay. My general expectation is that we will see something very similar play out. We will have initial jobless claims slowly trend higher. Again, next week is 225. This will probably change in the next few days. It's still quite early in the week. But in any case, we still could see them drop down to 220, 215 or something like that. But again, as we move towards the summer, I definitely do expect initial jobless claims to slowly grind higher. What could aggravate it is the layoffs, which is one of the things I was meaning to touch on. We have seen bankruptcies and job cuts get a significant bump in the month of February with 170,000 job cuts being announced as the number got released by the Challenger Gray report. 60,000 of which were government level job cuts. So 110,000 of them were from the private sector. And obviously that is not good for the economy. So already going into the year, you already have the case. You can make the case rather that we are on the slowing down path rather than acceleration. And the way you can also visualize that is with the quits rate, which again I've made the case for why I love the quits rate, and the idea is very simple. It is a reflection of people's sentiment. Okay, it's the best kind of survey you can possibly have, for the simple reason that whenever you see quits rate, the quits rate being at cycle highs, you have sentiment being very high, people acting aggressively, people acting in the work in the labor market, because of course if the quits rate is high, that implies that people feel confident that they can find another job, which in turn pushes compensation higher, which in turn pushes consumption higher. The opposite is true when you have the quits rate at a low level. People tend to act more defensively. They'll hang on to the job because they're not as confident as they were back here that they can find another job. So that in turn feeds into more stagnant compensation growth, and so consumption gets hurt as a consequence of that. This is one of the reasons why I've been kind of fading the inflation narrative, because again, the reason why you have a very nice correlation between headline inflation rate and the quits rate is because they're basically, again, they are one is a consequence of the other. If you don't have the higher wages, okay, that allow people to chase after prices and continuously, provide a bid for goods, you're not going to have that upward pressure on inflation. Of course, you might see a short-term blip, which again I've been arguing for in my previous videos, and again also you can see it in the very short term. Like, we had the quits rate bottom in September and kind of go sideways to slightly up, and that is kind of what we've seen in the inflation rate. It's kind of been drifting up, and I've said again in my previous videos that this isn't something new. We've seen it in the last 2 years of this cycle, like in 2022, even when this inflationary trend was well on the way, although it was still pretty high. You did still see kind of small bumps that slowed down the disinflationary trend. This is very more apparent when you look at something like late 2023, where you have the quits rate stay stable and inflation kind of stay sticky around the 3 to 3.5%. And as soon as the quits rate started to come down in in April, you saw inflation follow suit. Okay, so again, I'm as things stand right now, I tend to fade the inflation narrative, even though we've had things like the University of Michigan kind of possibly pour fuel on top of the inflation scares. But again, I've grown to kind of disregard the University of Michigan any survey conducted on on a group of people, because basically when you have surveys, what you are measuring is people's opinion, and people's opinion can be easily skewed by political biases. And this is the University of Michigan consumer survey that came out on the beginning of February, where we saw inflation expectations break out dramatically. But if you go and dig a little deeper, you'll see that most of the move came on the back of Democrats actually expecting inflation to skyrocket. Okay, and why do they expect that? Because Trump got elected. Now, that isn't me judging Democrats. That's just pointing out a simple fact that if you ask people their opinion can be, again, skewed by whatever political ideas they have, what happened in the news. And so whatever kind of signal there might be in these surveys gets ruined by all the noise that is associated with, again, political leanings. And so when it comes down to surveys, I think that the quits rate is the best survey that you can have. And again, this just paints the picture of where we are. I wouldn't be surprised if we continue to see the quits rate drift lower as well, given the fact that we've had this period where from September up until now, where, again, I've said it before, you usually do see the quits rate kind of go sideways during the fall to February, March, and go sideways again. But on the other side of that, what you have is a continuation of the previous trend. So I wouldn't be surprised if over the following months we see the quits rate drop, which in turn would put downward pressure on inflation, and which would in turn put again downward pressure on yields, and so TLT could be a very big beneficiary of such a move. And so really, the reason why I expect this to be a story of the summer rather than right now is because if you were to see what we have right now, so we have layoffs, and the second big factor is tariffs. If these two factors continue to, continue, I mean, again, pardon the expression, if they continue as we go into the summer, it'll just feed more uncertainty into the marketplace, and it'll continue to feed this risk-off trend that we've had ever since the end of February. And risk-off, of course, is bullish for bonds. Now, the other factor, again, as I hinted at just a moment ago, is tariffs. The problem with tariff isn't so much the fact that there could be tariffs. It's the fact that they continue to be the saber rattling, as I mentioned in my previous videos. The fact that we have tariffs, then we don't have tariffs, then we might have tariffs, then it's April 2nd, but then April 2nd will come, and then by the time April 2nd comes, it's going to be a completely different environment. Again, that just feeds uncertainty into the system. And while we're on the topic, tariffs, are they inflationary or deflationary? Again, I defer to the quits rate. To me, the question is it inflationary or not? It really depends on the timing of tariffs. If we had tariffs during a time of expansion, so let's say if Trump was still in office, again, he was in office, but let's say we had this kind of acceleration in the quits rate right now, and we had tariffs get applied, yes, arguably I would be on the side that it would be an extra tailwind to inflation because people have the means to kind of keep up with inflation. But given where we are now, the effect I'm expecting tariffs to have is, of course, as people front run tariffs, you'll have a small bump in inflation. Okay, it's kind of a self-fulfilling prophecy at this point. But on the other side of that, given the fact that we are in a cool state of the labor market, and given the fact that compensation is likely to stay stagnant, the end result is that tariffs are just going to be a drag on growth because people don't have that extra income to compensate for tariffs, and so they're just going to say, I quit. I can't, keep up with with these price increases, and so I'll just won't buy whatever I was going to buy. Okay, And you'll see that manifests, if this is correct, also in companies and their margins, where because companies know, again, if this is true, that they can't pass on these price increases to their customers, the only thing that they have left is, well, to fire people. Okay, because somebody's gonna have to eat that increase caused by the tariffs, and the only thing they can do if they can't pass those prices on to the customers is to lay people off. Okay, and this is something that kind of got hinted at in the PMI report here, highlighted in yellow. Again, while inflationary pressure remain muted, this reflected in a squeezing of margins. Okay, because again, companies are seeing more and more that they can't pass on those price increases to the customers. So if this is correct, tariffs will just be a drag on growth. Okay, so it'll feed into employment and eventually to layoffs. While we're talking about layoffs, I want to address something quickly before, again, we go back and look at the TLT chart. The notion that we have a strong economy because initial jobless claims are low. Again, the way I've talked about it in my previous videos is, it's like saying, I'm going to wait to have a shower until I smell like rotten eggs. I mean, you're already late. But if you're waiting that long, you're going to be late. By the time initial jobless claims really start to, move up significantly, you're already well in a recession. Okay, in a again, rather not recession. Let's call it, just not to be over dramatic, in the acceleration of the slowdown. Okay, so you're already in a slowdown, and then it kind of starts to gain traction. So again, the fact that we have initial jobless claims at lows, it isn't surprising. Initial jobless claims are usually the last thing to happen in the business cycle. Okay, usually slowdowns that become recessions aren't born out of layoffs. They are born out of low hiring. Okay, let me see if I can bring this up. Okay, so recessions aren't born out of this right here. This is just a manifestation of it. This is where the recession brews, and then where they kind of create where the conditions are created. Okay, and when we're looking at hires, we're definitely off the cycle highs, and we are at levels seen in 2015. Okay, so these are all clues, just trying to bring everything together, that the trend isn't an acceleration, it's a slowdown. I think it's sensible to say that the US is not in a recession, it's in a slowdown, which doesn't mean that things are falling apart. It just means what the word implies. It's slowing down, and as things slow down, you become more prone to any negative shock. Okay, so it just leaves you more vulnerable, is what I'm saying. Okay, and just to point something else out, the yield curve is something else that people like to look at, and I made a video on this not too long ago. The yield curve, it predicts a recession, it doesn't predict a recession. Usually, you usually tend to see a recession, it's not the amount of time that determines when you have a recession or not. The first red flag is the 50 basis point spread between the 10-year and the 2-year. Okay, so if we were to see, for whatever reason, now say that the next non-farm payroll print comes in weak, which is something that I've seen analysts point out after the last yesterday's report. we could see the spread between the 10 and the 2 go over the 50 basis point spread, and at that point I would expect things to start to move a little bit faster. Okay, if you go and look at history, whenever we got over the 50 basis point spread, that's kind of when things went awry. So I can see that in 2020, March of 2020, going back to 2007, 2008, that's basically when you saw the recession start. And by the time we were over the 100 basis point spread, that was just the way the yield curve's way of telling you something happened. The 50 basis point spread is saying something might be happening, and the 100 basis point spread, measured in the red line, is the market's way of saying something happened. Okay, something might be happening. Something happened, and you can go as far as you like. And as I've said, given the fact that we are in a slowdown, any negative shock will again be a tailwind to the return, the possible return again of the bull steepener highlighted in green that we had last year in last summer. Right now we're kind of in a again, we've kind of been in a bull flattening. Again, rates have been kind of all over the place. What really has been dropping significantly has been the 2-year. Again, everything in general across the board, we've seen lower yields, but the most dramatic, I would say, has been in the 2-year. Now being back at 4. But just to go back to the yield curve, watch for the 10-2 spread, okay, as an indication. As soon as it goes over 50, that'll likely be the signal that something has come up, be it in the form of maybe an inflation miss, so inflation coming in cooler, or the non-farm payroll report being a bust. Going back to TLT, being in a slowdown, of course, that is a tailwind for bonds, again, because the 2-year really is the market's way of telling central bankers where to place interest rate policy. If you look at the 2-year with the interest rates, you'll see that interest rate policy gets, usually sets the tone for where the Federal Reserve or central banks will go and put their own interest rates. So again, the 2 years, again, a way for the market to speak to central banks. The further out you go on the yield curve, on the yield spectrum, again, the 10-year, the 20-year, the 30-year, they're more a reflection of growth and inflation expectations. So if you see a slowdown, which we are currently in, you're likely to see yields go down as a reflection of the slowdown. And again, as inflation expectations come to go down as well, you'll see yields come down. Again, if I'm correct, which that is a big ask, I would expect yields to slowly come down, okay, with a few hiccups here and there. One of them possibly being next week with a possible retest of the trend line we have previously broken out of. Now, just to get more specific on TLT, we did have a retest of the bull market support band, which is a nice thing to see. Previously being a source of resistance, now it has become support. Again, whether this holds as support, continues to hold as support, will be dependent on the way the data comes out. Now, the first real data point is the jobs JOLTS report that we have on Tuesday. it could move things. Although it's, you should always take the JOLTS report with a grain of salt. I think that the best thing to come out of the JOLTS is the job quits rate, as I've pointed out even in this video, rather than the headline number. Given the fact also that this is, again, it's coming with a quite significant lag. We're looking at January numbers at this point, so we're definitely looking in the rearview mirror as far as that is concerned. But as far as a possible retest of the trend line is concerned, look at CPI on Wednesday. If we do end up having a inflation coming up perhaps a little bit hot, brace for a possible retest of that. It doesn't have to happen. Again, this is just a possibility. But given the fact that given everything I've said up until now, I'm expecting inflation to start cooling. If not this month, in February, I would expect it to see in the next months. Okay, and that's why I also preach that it doesn't really matter where this current non-farm payroll report really comes in. It really depends on the trend. Okay, the difference between a trend and a blip is the follow-through. We could easily have one month of bad data and just revert the next month. What you need to see is a continuation. You have to see this month as well the following months in order to say if the slowdown is continuing or if things are changing. Again, I've made the case that things are unlikely to change, and the only thing that would really derail this view is, say that we have some kind of like pandemic era stimulus. Okay, something like a stimulus package. The government paying people directly with stimmy checks. That would definitely unravel things. Even if we were to see, say, further tax cuts get passed in Congress, that would really be a 2026 story rather than a 2025 story, because that'll apply to this year's taxes. That'll get paid next year, and so the effects of the tax cuts won't really get felt till very later on. So the only thing that could really unravel this, and now that I'm saying it, knock on wood, but again, not just because of TLT, but because of generally speaking, we don't really want to go back to that pandemic era stimulus. So again, that would be the only thing, in my view, that could derail this slowdown. Again, an intervention. You'd have to see an intervention to block this kind of bleeding, quote unquote. If these things continue, so if you continue to see tariffs, if you continue to see, the saber rattling of tariffs, if you continue to see layoffs and cuts in the federal level, expect that to be a drag on growth. And as things already at a seasonal level tend to play out, again, just going back to the initial jobless claims, already on a seasonal factor, you tend to see initial jobless claims trend up. Okay, if we were to see again the saber rattling of tariffs and layoffs continue, my best guess is that initial jobless claims will continue to rise up, and then that leads us into the summer. Now, this is my base case. A slowdown leading to continue and get potentially a little bit worse as we go into the summer. Now, what could happen in the summer is if that continues and we don't see any like pandemic era stimulus come out, or zero interest rate policy coming back, is one of two things. Well, first off, the short answer is a landing. Okay, the long answer is either a soft landing or a hard landing. Now, given the fact that interest rates act with a lag, and given the fact that probably, Anna Wong came out on Bloomberg. She had an article on, I saw an article on X saying that we are just exiting the long shadow of the Biden administration stimulus. As we move towards the summer, you'll likely just begin to feel the effects of all the rate hikes that we saw in the previous years, as well as the fact that we no longer have that tailwind from state and local government spending, as well as at the federal level. And it really all depends on how things compound from here on out, and how we get to the summer. Because if we were to see tariffs continue to put uncertainty into the system, if we continue to see layoffs come around, well, first off, that'll have a negative effect on stocks. Okay, so if we continue to see stocks bleed, which again we could see, I said yes in yesterday's video that I could easily see a stocks rally back up to the bull market support band. But again, if even with bumps in the road, if we see stocks correct, that is just the inverse of the wealth effect. So think that all the people that have gotten money out of stocks going up, well, you have the exact opposite effect. You have people possibly starting to spend a little less because you don't have that extra income coming from the stock market. You potentially start having a bit more of a negative view on the economy, so you start acting a little bit more defensively. So again, it is really a summer of 2025 story, and it depends how you get there. If you get there with stocks, having corrected more, that just pushes the chances of a hard landing higher. If things are still in a benign situation, I think that the case for a soft landing is more likely. But either way, as long as these things continue to manifest themselves, again, tariff, saber rattling, and layoffs, the likelihood of a landing, whatever shape or form it takes, just go up. Okay. And again, what I would imagine in the case of a landing is, well, first off, to break through this parallel channel. Okay, so actually confirming that this here is the kind of double bottom this is the definitive double bottom. And the reason why I have this white trend line on the bottom is because I've gone over that in my previous videos. TLT as a representation of long end yields really like to put in double bottoms, and the examples I point out are two: the 2008 cycle, where yields put in a double bottom with a slightly lower low, so yields sweeping the previous high, or the 2010 example where you have a double bottom with a slightly higher high. And again, if the slowdown continues, the chances of this being a 2010 scenario where we have a slightly higher high could rise. Okay. So that's one thing, a confirmation of the higher low. Second, I would expect a breakout of this parallel channel that we've had for a year and a half, more or less, a breakthrough. And in the case of a soft landing, I would imagine yields topping out at a 380, something like that. Okay, so TLT at 110. I think that would be a reasonable price target in case of a soft landing. Okay, If we were to have something a little bit more serious, I would expect this trend line to be broken. And again, as I've said in my previous videos, trend lines are meant to be broken. Again, so in the case of a hard landing, where would I see rates bottom out? Lower, and the first level would be 250. So revisiting right here, 135 on TLT. If things get unravel more, if we have a soft landing, again, anywhere between 110 and potentially 120 as well, I wouldn't be shocked by something like that. Again, this is really speculation of my personal speculation. So again, this isn't really meant to be taken serious. This is just my opinion. But again, if we see a soft landing, I wouldn't be shocked by 110 or 120. If we see a hard landing, the least is 135. And if we see things get even worse than that, well, anywhere between 135 and potentially 170. Although I personally wouldn't be hoping for that. Okay, again, I hold TLT, but something that would make TLT go to 170 is something really negative. It's really hoping for a bad scenario, and again, TLT kind of is throughout history the insurance play against negative events, slowdowns, bad slowdowns. But again, just coming back to reality. Again, in a case of a hard landing, I would expect this trend line to just plow through it and get to around the levels seen in 2021 and again just before the pandemic. I think that is a reasonable target for the 30-year yield. Okay, so somewhere around 2.5, somewhere between 2 and 3%. Okay, and 2.5 being my, if I really had to put a number on it, in case of a hard landing. Now again, that is if we have some sort of a landing and we don't have any intervention in the meantime. That's really what you have to be paying attention to, because what we've seen in the market so far is that the sentiment is risk off. And what has kind of been broken is the idea of the no landing. So what has accompanied stocks rallying to these new highs right here is the fact that we've been in a no landing economic environment. What does that mean? It means that the economy just keeps chugging along. It means that things are okay and things can rally, because again, risk assets, as I've said before, and as everybody knows, they don't really need a reason to go down. I mean, to go up, they really need a reason to go down. And what we've started to see possibly in these last few weeks is stocks just starting to consider the possibility of, again, that kind of risk-off environment where you have a lot of uncertainty. You have potentially the fiscal side of things possibly tightening up, so that'll have a drag on growth. And uncertainty caused by tariff, saber rattling, kind of being the icing on the cake. So again, if you continue to see things play out, the chances of a landing occurring go up. And then, only then, can you start to consider whether it's going to be a soft or a hard landing. What I think, and kind of just to summarize everything, what I think the market is kind of starting to realize right now is that we're in a slowdown, and we're trying to figure out whether this slowdown is going to end up in a landing or not. If this slowdown is just a blip, if it's something that is just a consequence of Trump's actions, or if it's something a little bit more structural. Again, given everything I said, especially in the first part of the video, if you look at the quits rate, just to reiterate, I tend to be more on the side that things are a bit more structural than just a mere blip. Okay, I think that people are telling you where things are really are, and if you were to ask me, I would say that it is one of the reasons why Trump won, and he won in a convincing manner. People aren't happy of the state of the economy. Full stop. And again, the quits rate is a perfect manifestation of that. People aren't as confident as they were 3 or 4 years ago. Okay, and whenever you see the quits rate low, that is not a good indication of the economy. Okay, so just to bring everything home, the quits rate is a great indicator because it's a survey of people's actions, not of people's intentions. It kind of tells you where inflation, at least headline inflation, is going. And as long as the quits rate continues to follow the previous trend, expect inflation to cool, and expect the growth side of things to come under scrutiny. So yes, we do have CPI, and I've made the case that CPI, at least in the very short term, could lead to a further retrace by TLT and retest the previous trend line. But in any case, even if inflation continues to be somewhat problematic in the short term, looking forward, as long as we are in a slowing economy, inflation isn't my number one concern. It would be the growth side. And again, one of the first indications you can have this month is the JOLTS report. So continue to look at the quits rate and see where it moves. Continue to look especially at the S&P PMI reports. I can't find them right now, but anyway, here they are right here. March 24th, that comes around the end of the month. Continue to look for any indication of the fact that we are exiting that seasonal blip that I've spoken about previously when looking at inflation. Okay, this right here. So looking at, again, light fall to around the March period, you usually see inflation get sticky. Okay, and this is something that we've seen this year. And again, as I've said in my previous videos, this year we've also had, on top of this, what usually happens, we've had port strike, fears of port strikes in September. We've had natural disasters and fear of tariffs. So we've had tariff front running. Okay, so all factors that have contributed to, I really shouldn't have this bull market's bull ban on this, really. But again, all factors that have pushed inflation higher. And again, look at economic data coming out from now on as a confirmation of the fact that we are possibly returning to the disinflationary trend. Okay, something more similar to the post March of 2024 until September. Again, I would lean to this actually occurring rather than inflation going back up. But again, even if we were to see inflation go back up, I would expect it to have to be a drag on growth. If you look at history, inflation usually picks up at the worst possible times. Again, if you look at 2008, you had inflation go up while the slowdown was occurring. You actually had it go up at 5.6 a few months before Lehman Brothers collapsed. If you look at 2001, inflation was at cycle highs. If you look at the 1990s, inflation was at the cycle highs just before recessions hit. And of course, every recession is different. These all came because of different reasons. But again, inflation has the bad habit of becoming a problem at the worst possible time. So it's important to consider where we are in the cycle, because again, inflation can have consequences depending on where you are in the cycle. I tend to be more on the side that, given the fact that we are no longer in the expansion period, as suggested by the quits rate, we are in the slowdown period. Any bout in inflation will just have a negative effect on spending, as people just see their disposable income go down because they have to just spend more money for the same things, seeing that they don't have a way of getting more income, as suggested again by the quits rate. And on the corporate side, you'll see that manifest in margins getting squeezed, as said again in this month's PMI report. And the only way corporations have, the only way that corporations know how to defend their margin is by laying off people. So a further, tailwind to the slowdown. So the bleeding continuing throughout the summer. And if this is really the case, that just raises the chances of a landing. And if it is a soft landing, meaning that, yes, it might be a bit bumpy, but it's nothing too dramatic. In either case, my expectation is that we see this parallel channel get broken. If it's a soft landing, anywhere between 110 as a first target is sensible, I think. I wouldn't expect it to move any, significantly higher than that, maybe 120 in case of a soft landing. In case of a hard landing, I wouldn't be surprised if we were to see TLT at 135 to 150, somewhere like that, which, again, if you wanted to put it in yield terms, that would look like 2.5 on the 30-year yield or 1.5, something like that. Again, those are just rough estimates. But again, this second part, whether we have a landing or not, is speculation on speculation. It's kind of speculation squared, because really that is something that the market is trying to figure out at the moment as well. Is this a slowdown? And will this slowdown continue? And if it is, you're likely to see stocks continue to correct. And that'll, again, just raise the chances of this being of there being a landing in the summer. Okay. If not, if you see something like zero interest rate policy return for whatever reason, or you see pandemic and stimulus come back, that would be the intervention kind of needed to stop the bleeding. If we do see that, again, that'll be the kind of the end of any possible rally in bonds. But as long as we don't see that, the trend is up for bonds, and negative news. So expect initial jobless claim to slowly rise higher. Expect non-farm payrolls to decrease, and expect the unemployment rate to go back on the previous uptrend. Again, what you have to pay close attention to this month really, and the following weeks, isn't so much CPI, but really how the economy is holding up. So look at the end of the months, S&P Global numbers get released, and yeah, that I think I'll leave it at that. I hope I did a good job of explaining what I think. If you like this kind of content, consider leaving a like, and I'll see you next time. Bye.